Welcome. Thank you for stopping by. I always appreciate the support in my videos. My name is Scott Nelson, founder of Thrive Wealth Strategies. I'm a financial planner and also an active investment manager. Today I'm going to answer one of the top questions I receive from people whenever the stock market gets a little bit choppy. Should I sell? Is there anything I should be buying? And I'm going to answer that by giving about as many cliches I can pack into an answer. Just like in financial planning, if you fail to plan, you plan to fail. And investment management is the same way. If you wait until you're in the moment and you're getting all these headlines thrown at you, rising inflation rates, mortgage rates are through the roof, housing market bubble, oil prices renew record highs, turmoil in whatever part of the country is going on when you're watching this video. Fill in the headlines. The emotions are there for clickbait. They're not there for investment advice. So how are you going to react when these things come to you? Are you going to let your emotions drive it? And there's almost every single investment company has this, but the one I'm going to refer to is by Vanguard. They did a study where they took a look at the 20-year track record of a retail investor, you, versus just buying the broad market index. Over the course of time, the retail investor lost by an average of 3% per year. And the reason is emotions. Getting in and getting out and thinking you can time the market. So instead of timing the market, they're making the idea that time in the market is the way to go. I would argue that if you actually have an investment policy statement where you can actually have the idea of, depending on the environment, things you should be overweighting, underweighting, little tweaks you can make, not to be neglectful of the news, being mindful of the opportunities that the news headlines and the economy presents. So in today's presentation, I'm going to go through my proprietary Thrive method and help you develop the confidence to have an investment policy statement and have the tools to be able to tweak your investments throughout every market cycle. Thank you for joining me. The stock market crashes a lot. We have been quite spoiled over the past decade. If we take a look historically, since 1927, on average, every 3.5 months, we had a 5% reduction in the stock market. There have been 27 declines of 10% and more since 1945, and these declines require an average of 4 months to bounce back from. So if we get a 10% decline, and you panic, you sell out too late, you're going to miss the rebound if you don't get back in almost immediately. So not necessarily getting all in, both feet out. When you get that 10% decline, what should we rebalance to? Are there any opportunities? Did something decline more than it should have? Is there something that is destined to bounce back, or something that's going to weather the storm? Is there tweaks that we can make without going 100% in, 100% out? And additionally, since 1928, we've had 25 declines of 20% or more. These do take a little bit longer to unwind, on average 299 days. But over time, the markets so far always recovered. That's what the pundits say. That's what the other advisors say when they talk about buying and holding. And sometimes if your goal is long way away, if you have a decade or so to plan, sticking your head in the sand is the right thing to do. You might want to just weather the storm. But what if you are starting retirement or a couple years away from retirement and you're starting in one of the red sections? These have lasted 15, 14, 9 years. So one of the biggest risks in retirement is sequence of return risks. Same portfolio can average 10%, but if the first couple years are down 10, down 20%, and you're drawing down those assets, the way you start retirement is much more important than the way you end the retirement. So losing money, a significant chunk of money, as you're drawing it down, is going to significantly impact your ability to stay retired. Let's go back even further. Since 1877, there were 80 years where the stock market was considered in bull market territory and 52 in bear market territory. So bear markets are much more likely than bull markets. And not only are there more years of bull markets than bear markets, the severity or the magnitude of these markets is much greater. So the secular bear market on average declined the stock market by 65%, and the bull market increased it by 415%. Having a longer term perspective can certainly help improve outcomes. If you have an extended enough time frame, you can weather a bear market. Only 5 times since World War I have we seen the S&P 500 have a negative rate of return for a 5-year span. Now, we did talk already about if that happens at the beginning of retirement, how much of an impact that could have. So we do have some strategies to combat shorter term volatility. For more information on that, visit my blog at thrivewealthstrategies.com and search for the 3-bucket strategy for income planning. If you hold on long enough, you're going to be able to wait this out. So if you take a look at, since 1950, there's been 63 10-year rolling periods. And when I say a 10-year rolling period, I'm looking at any 10-year block of time. So between 1950 to 1959, 1972 to 1981, 1999 to 2008. Of those 10-year rolling periods, there's only been 2 of them that produced negative rates of return. And if we go further back and extend it further out, to 1871, there's only been 3 negative 15-year periods. As we go further out, we can extend this to 30 years. And historically, there's never been a rolling 30-year period that's produced a negative rate of return. We've established the case of equities, and we've also established that there is some sequence of return risk. This ties in nicely to the teachings of our parents, grandparents, great-grandparents. And this next part of the history lesson, I'm going to have to go back to 1935. That's the year that Social Security was rolled out. The average male in 1935 lived to age 59 and a half, and the average female to age 63. Social Security starts at age 65. They were not budgeting Social Security for people to be on Social Security for 20, 30, 40 years. Nowadays, people may be in retirement longer than they were working. So we parlay this into someone in 1935, 1940, 1945. They were raised with the intimate knowledge of the Great Depression. And they knew that there was a chance that they could lose it all by being a risky equity investor. So what did they do? They put the money under the mattress, buried in the backyard, bought bonds or gold or CDs, whatever might be secure that they could draw down throughout their retirement. These lessons were passed down to my parents, the baby boomers, and they, in the back of their mind, they thought that there was too much risk to be in the stock market during retirement. I would argue that there was actually more risk in living too long, longevity risk, and inflation risk. Prices are going to be going up, and if you put your money into something secure, 20 years into retirement, you're not going to be able to afford the same lifestyle. So imagine if you retired in 1988, and I told you that the price of a stamp is indicative, as a proxy for all your spending you need to do. So that 25-cent stamp, you can use that to pay for your housing costs, your gas, your electricity, your food, your travel, your gifts. Everything is bought by that 25-cent stamp. Bond yields back then were 10%. So if we use the philosophy, we're just going to put our money in something safe, spin off the interest, and spend it on our lifestyle. You would need to put $2.50 at 10% to spin off that 25 cents. Fast forward 20, 30 years into retirement. The inflation of that stamp and all the stuff it represents is now made that same stamp, that first class stamp, cost 49 cents. What's going to happen is your $2.50 worth of bonds, interest rates are down, isn't going to be even spinning off the same 25 cents. And even if it was, it wasn't covering your inflation. So being too conservative is going to backfire. And that's my case again for having equity type returns, but also having diversification. We're going to need something to spin off some income. We're going to need something to diversify and protect us against the short-term losses. We're also going to need something that's going to grow and keep up with inflation. So having money available that's secure to draw down at any time, regardless of where the stock market is, but also having money out there growing that we can use to replenish those bonds and add that to them. But you certainly can't outrun inflation with bonds alone. This next slide is a little bit busy, but I'll point it out to you. The yellow line I put there represents what the bond yields are. The blue line is how much the stamps cost. And the scale of it doesn't show, but it's increasing a little bit. What the green line is showing is how much you have to invest into a bond to generate enough money to buy those stamps every given year. So as interest rates are down and bond prices are up, that green line is just going up exponentially, parabolically. So my case here is, if you retired 20 years ago and you only needed $3,000 worth of bonds, and now you're into retirement and you need $12,000 worth of bonds, where's that money coming from? You have to be able to replenish those bonds from somewhere. So in order to generate the income, you're going to need to have something with equity-like returns. There's several ways to evaluate the economy's direction as a whole or for individual investments. Let's talk about key market indicators I use to build my portfolios, and they can typically be put into two categories. First one is fundamentals. This is going to give me a better idea of what specifically to buy, and technicals are going to give me an idea of when to buy and when to sell, when to overweight and when to underweight different asset classes perhaps. So some of these technicals are trend analysis, momentum, and relative strength. I made it nearly halfway through this presentation without any sports analogies, so whoever predicted the 14-minute mark as the over-under, congratulations, you win yourself a prize. Now this one I couldn't help myself because it lends itself so nicely talking about college football rankings and relative strength rankings. So each Saturday, the teams play, and there's a winner and a loser. And behind those wins and losses, there's other statistics that can incorporate deciding which team is stronger. And then they can incorporate those sorts of rankings. So how many points you score, how many yards you allow, whether you have team injuries, who you beat in the previous week. So all these factor in. And there's a number 1 ranked team and there's a number 25 ranked team. The number 1 team will not always beat the 25 ranked team, but more often than not they will. And as that number 1 ranked team plays more games, they may be playing a close game against an unranked team. They may have a key injury. There may be reasons why, without losing, that they're going down in the rankings. And that 25th ranked team might have all the momentum in the world, and they may be playing amazingly well. And they'll be going up the rankings. And if later on in the season there's enough data out there, and the 25th ranked team might be ranked higher, and they may end up being the favorite against the number 1 ranked team at the end of the season. So same thing works in investing. As we accumulate more data and learn more about these different asset classes and investments, the momentum may shift. And that's what we need to do here, is rank the teams, rank the assets against each other, and not necessarily go all in. You're not going to go to Vegas and put your life savings on the number 1 ranked team. That would be ludicrous. But you're going to want to put more of your assets in the top ranked asset classes. And if something is got no momentum and is losing every game, it wouldn't be wise, just for the point of diversification, to put money in there until they show some signs that they're turning around. Relative strength as a way to predict the direction of the economy has been around since the 1800s. Merchants would use this to figure out where the momentum is in the supply-demand and use this to really set up their commerce. As we dig in a little bit deeper, what the point and figure charts have evolved to, you'll notice if we zoom in, columns of X's and columns of O's. X means a rising price and O means a declining price. So as you compare two things against each other, and X means the investment A is got more momentum, and the O means the other investment B has more momentum. So as we see a trend, we consider 3 X's or 3 O's in a row a trend. And then as he dug in a little bit deeper, without getting into an investment thesis, if you want to learn more about this, I'm happy to share some resources or set up a 15-minute call to nerd out about such a thing. But for the general purpose, I want to point you to, there's different things that indicate buys, different things that indicate sells. And what I'm doing is on a weekly basis, comparing the strength of different asset classes and trying to figure out which one has the momentum, and weighting and overweighting and underweighting assets to take advantage of the data that we have at our hands. Supply-demand is economics 101. And I love how it can be applied to just about anything. So we can compare supply-demand momentum of stocks versus bonds, currencies versus commodities, And inside of each of those asset classes, we can put agriculture versus oil, large companies versus small companies for stocks, value versus growth companies. So I hope you can see where this is going. We're going to try and figure out where the momentum is for the macro and the micro and overweight the things that have the momentum. And it makes sense. Take a look at the real world example of, to battle the pandemic as a whole, though, not just our country, but the entire world printed a ton of money, adding so much monetary supply. And then there were supply chains that were diminished. So there was less supply of goods, higher demand of goods because there's more money out there. It didn't take, Nobel Prize in economics to understand that that was a recipe for inflation and rising prices. So we're going to be looking at the same things, looking at some trends. Overweighting, if it's an environment that's breeding inflation, let's look at what's going to do well during those environments and take advantage of the momentum and position ourselves so we don't get hurt by it. There's many, many things we can do with these point and figure charts, and I'm going to save some of the details of this for 201 version of this presentation. But one I did want to really, really quickly glance over was the NYSE bullish percent. So we put guardrails on some of these where if we get too far, into a green zone where it's a low risk environment or too far into a high risk environment, we're going to be even more diligent as far as maybe checking the point and figure chart a little bit more often and understand that there is indication that a shift is coming. So let's look at relative strength and actually compare two asset classes historically. So in this chart, we're going to look at S&P 500 SPX and Barclays Aggregate Bond Index AGG, stocks versus bonds. Now, compliance had a field day with this, so read the disclosures. It's pretty obvious that these are not real recommendations. I was still in college when this chart started, so I back tested this 25 years just to show you two things. Number one, momentum lasts a long time. There's not going to be buying and selling things on a weekly, monthly basis. Sometimes there's 7 or 8 years between buy and sell indicators. And the second thing is, it's not infallible. If you take a look at 2016, the stock market was up and the bond market was down, even though the relative strength would indicate otherwise. So we're never going to use this as a recommendation to go 100% in or 100% out of the stock market. What we're going to do is we're going to say, should be overweight, should be underweight? Is momentum indicating that we're in a favorable or unfavorable environment? Look at what the S&P 500 did over those 20 some years, and look at what the aggregate bond did. Both of them were positive. Both of them would have been decent investments. But if you used momentum and you shifted from one to the other, you would have outpaced both of them. So using these, along with our guardrails we're going to talk about soon, to decide what's overweight and what's underweight has historically done well, and it gives me the conviction as the investment advisor that we're going to be following the trends and not the headlines. So using the technical and fundamental analysis to evaluate the momentum and the actual statistics is a much better way to go about it. Take a look at the headlines going into the pandemic. We had no idea how severe it was going to affect our economy and what the shifts were going to change. February of 2020, people were predicting that this longest bull market that we're experiencing was going to continue indefinitely, and nothing was going to derail it. And then all of a sudden we had a 30-something% drop in March, a month after all these headlines. And on the flip side, coming out of the global economic crisis of 2008 and 9, everything was still doom and gloom. These articles came out 3 months after the momentum had already shifted. As we were getting indications that things were starting to right themselves, people were still playing on emotions, and everything was doom and gloom still. So it might make you miss the largest or longest bull market in economic history just by following the news stories and the headlines. But remember, point and figure charts do not do a few things. They do not measure which way major indices should go. Tell us whether to play offense or defense. tell us the magnitude of any expected movement. Relative strength matters for asset allocation. The asset classes that I track and compare on a weekly basis are U.S. equities, international equities, fixed income, commodity, currency, and cash. Trends. Do you follow or do you adapt? 2 or more trends can be better than 1. This is not going to act like a crystal ball. It will tell us when things are starting to slow down and identify asset classes that are starting to speed up. The fastest human can go around the track 1 time in 43 seconds. That is amazing. But what if he had 4 amazing runners? And as one of them starts to slow down, pass the baton to one that's just starting to speed up. So the 400-meter record is 43 seconds. I equate that to investing into the top asset class over the course of history, perhaps U.S. equities. But what if we were prepared to pass the baton from one to the other as U.S. equity starts to slow down and replace it with something that's starting to speed up? Using relative strength for portfolio allocations. At Thrive Strategies, I have developed the Thrive methodology. We evaluate relative strength, supply and demand, of different asset classes and rank them based on relative strength scores, high to low, while considering other factors such as your risk number and other conditions. Step 1 is identifying the investment options. Step 2 is performing a relative strength analysis. And step 3 is rank each asset class. This is a real screenshot from April 10th, 2020, just the beginning of the pandemic. You'll recall that the stock market had the sharpest decline in market history. Went from a bull market to a bear market, the fastest it's ever happened. So relative strength takes 6 months worth of history and indicates where the momentum is currently. And then we boil that down to where we think that people should be overweight or underweight based on who has the momentum. So taking a look at, even before this chart, the 1980s, it was not the best environment for economic growth. Interest rates were through the roof. Inflation was through the roof. As those things came under control, we entered the 1990s. It was a perfect environment for economic growth. As interest rates started coming down, inflation started coming down, it coincided with essentially the birth of the internet as we know it. Companies were born, productivity was high, and opportunity was abundant. Domestic equities dominated the 1990s. As we were starting to get towards Y2K, the turn of the millennium, things started to shift. The tech bubble burst, 9/11, housing market crisis, record high oil prices, followed by the financial crisis. So that was considered a lost decade for many investors, where if you invested on January 1st of 2000 and held it through December 31st, 2010, there's a lot of things that didn't make any money for an entire decade. But didn't mean there wasn't opportunities as momentum shifted. There were definitely asset classes all along that had momentum. As we came out of the 2000s and into the 2010s, the financial crisis was behind us. We entered what we now realize was the longest bull market in the history of the economy. 89% of the time, domestic U.S. equities were ranked number 1. Relative strength works for asset classes and also asset sectors. And when I say asset sector, I'm talking about things like technology, healthcare, energy, consumer staples, consumer cyclicals, and so on. We're always just seeing this chart where if you just buy and hold the S&P 500 over a long course of time, it starts in the lower corner and goes up to the top corner and ends at some ridiculous number. That's the case for buying and holding. But let me give you another scenario. What if we compared that chart to what if you had the crystal ball that told you the exact day to sell and the exact day to buy back into the S&P 500? You never lost a penny. You had impeccable decision making. And let's compare that to a third scenario where you are going to be fully invested in equities at all times. But the equities you're invested in are only in the top ranked sector from a relative strength standpoint. So even though over the past 20 years, you're going to have some dips, if you had the highest momentum sector, but always being invested, you're going to outperform the crystal ball by over 2 times and the buy and hold investors by over 9 times. Obviously, past performance does not guarantee future results, but the evidence is starting to pile up that momentum is a real thing when it comes to investing. What is Thrive investing? Thrive is tactical. It responds to real-time market conditions. Thrive is harmonized. It matches your long-term investment goals to your risk number. Thrive uses relative strength. It targets asset classes expected to outperform the broader market. Thrive is investable. It utilizes proprietary analytics to narrow down the entire universe of investment products, even ones that are not typically available to retail investors. Thrive is valuable. We are very fee conscious and we understand the effect extra fees and expenses can have on one's investment performance. Thrive is excellent in knowledge, client service, and wealth management strategies. Let's talk about what the Thrive method is and is not. The Thrive method is a way to identify market leaders. The Thrive method is an adaptable and tactical risk management tool. The Thrive method is based on objective inputs. The Thrive method is designed to capitalize on long-term themes of strength and outperformance. The Thrive method is not a black box to forecast the market. The Thrive method is not a static indexing strategy. The Thrive method is not dependent on subjective inputs, such as feelings or emotions or manipulated inputs. The Thrive method is not designed to identify the precise top or bottoms for securities or assets. One of the biggest variables when it comes to investing is risk. Everyone thinks about risk a little bit differently. I like to think about risk as how much of your potential future return are you willing to trade for a smoother ride along the way. The amount of risk you're currently taking versus the amount of risk you'd like to take and the amount of risk you need to take are often not aligned. This is why I preach financial planning. You need to figure out what your goal is and how much risk you need to take to achieve that goal. Now, you may be aggressively invested with a goal to retire at age 65, and you can reach that goal by taking a lot less risk. Or if you continue taking these risks, you may be able to retire at age 62. And on the flip side, you may not be on track to retire. In order to achieve that retirement goal, you need to either work longer or take more risk. These are things you need to know. We figured this out by using a program called the Riskalyze. You receive via email a simple 10-minute survey asking you lots of different questions, and based on your answers, the next question pops up until they have it narrowed down to figure out what your personalized risk score is. This risk score, we then compare it to your existing holdings. Each asset has its own risk score, whether it's corporate bonds, the S&P 500 index, an individual stock, tech or blue chip, treasury bonds. All of them have a score, and the way they combine gives your portfolio a risk number. Oftentimes, you're willing to take a certain amount of risk, but you're currently taking way more risk. And to achieve your financial goals, you have to pick somewhere in the middle. This is a tool that helps us determine which portfolio you should be in and make sure that you're comfortable in that portfolio and make sure that you understand the amount of risk you're taking and how it relates to the goals you'd like to achieve. Now that we've determined which portfolio you should be in based on your risk profile and your financial plan, let's talk about how each of these portfolios stay within that risk range. Right in the middle, the balanced portfolio is for people with a risk score between 40 and 59. Depending on whether we're overweight or underweight different asset classes, the score should always fit within that range. And we accomplish this by setting guardrails for the minimum and maximum of each asset class you can be in. So an example of the balanced portfolio, at all times you'll have at least 25% equities and at most 60% US equities. Same thing with fixed income, minimum 25% into bonds and at most 60% into bonds. And at all times 2% cash. We then use asset class ranks to determine what to do with the remaining money. In this example, we had 48% left. So imagine this cup has 48% of your money. We then take the number one ranked asset class. We then fill that asset class up until it's reached its maximum allowed allocation. We then go to the second, third, and perhaps fourth ranked asset classes until this cup is empty. We've carefully chosen what those guardrails are, what the minimum and maximums are for different asset classes, so that at all times you're within your stated risk number range. If you're a conservative investor, you don't have to worry about if US equities and international equities are top ranked, that your risk score is going to be something keeping you up at night. Or if you're a long-term investor with an aggressive risk score, you don't have to worry about being heavily allocated into conservative investments, therefore missing out on the potential of the long-term gains. This is simply a way that we can overweight or underweight and take advantage of the momentum that exists. Let's take a look at a real-world example on how these asset class ranks work. So August 1st of 2008, which is 45 days before Lehman Brothers filed for bankruptcy, thus signaling the start of the financial crisis. The fixed amount of 52% has already been allocated, 25% into US equities, 25% into fixed income, and 2% into cash. The 48% remaining had to be deployed. Number one ranked was currencies. The maximum we can have in currencies on our moderate portfolio is 10%. Commodities was ranked number 2 with a 10% maximum. Cash went from 2% up to 25%. So we've already spent 43% of the 48%, therefore leaving only 5% to add to our fixed income and nothing to add to the US or international equities. The associated risk score of this portfolio was exactly 40. So as investors entered the 2008-2009 financial crisis, their risk score was at the minimum of the range they were comfortable with. Let's fast forward 13 months to September of 2009. You might not recall, but March of 2009 was the official bottom of the stock market during the financial crisis. The next several months were extremely choppy, and by the summer, momentum had shifted enough that international equities and US equities were ranked first and second. Recall that we have 52% already allocated, leaving 48% to deploy. The number one ranked international equities was capped out at 25% for our moderate portfolio, leaving 23% to add to the US equities, and nothing for commodities, currencies, fixed income, or cash. This is as risky as our moderate portfolio can be, and the associated risk score was 59, right at the top of the risk score range. Not a bad place to be as we entered the longest bull market in history. One of my favorite quotes of all time is from Mike Tyson, of all people. Everyone has a plan till they get punched in the mouth. I could not imagine how a boxer could not have front and center on page 1 of their plan what to do when you get punched in the mouth. But let me relate this to financial planning and investment management as well. You must understand that between now and whatever goal you're working towards, the punches are going to fly. There's going to be obstacles, there's going to be things in your way. And without an investment policy statement predetermining how you're going to react to these punches, is going to force you to have emotions, fears, and headlines take over. You have to control what you can control. Knowing what you're going to do and how you're going to react is going to have a much larger impact on your ability to achieve your financial goals than anything else. I'm about to risk triggering a lot of my colleagues with my next statement. Buying and holding because you don't know what else to do could be the lazy and wrong advice. Now, if given the choice between letting emotions, fear, and greed determine your investment selections versus buying and holding, then of course buying and holding. But fortunately, those are not the only two choices we have. We can have a plan of how we're going to react to it. This makes me think of some of the best advice I ever received. This advice came from a wilderness guide on a White River rafting trip just after college. Before we went out, he sat everybody down and made sure that everyone was paying attention to the plan that he was about to lay out. Because if he waited until we're in the rapids, then it would be too late. So instinct would dictate when the waters get choppy that you hold on for dear life. But this is the exact opposite of what you should be doing. Because if you're holding on tight, the water and the river are going to decide which direction you're going. And inevitably, it's going to bring you to a more dangerous place. So the instructions we received ahead of time was the guide is going to be sitting up a little bit higher, surveying the whole scene, taking a look at using his experience and watching how things are panning out to determine the direction we need to go. And when he yells paddle, with all your might, you're supposed to paddle the direction that he's telling you to go. This is going to alter your course and get you out of those rapids as fast as possible. Get through it unscathed. So as the stock market gets choppy, holding on tight, just for the sake of holding on tight, is not necessarily the right advice. Having a guide who's watching and analyzing the data and coming up with the best strategy to get out of this, using the information at hand, and not acting emotionally. So it's never too late to reassess this. Even if right now we're in the middle of this choppy market, it makes sense to assess where you are and where you need to be. And if paddling as hard as you can a different direction you are right now makes sense, that's something you should certainly consider. I implore you, click the link at the end of this video. Take a risk survey and set up a phone call with me to see what that risk score means. how it relates to the portfolio that's appropriate to you. And if there's any types of changes necessary, I'm happy to spend the time with you to help you evaluate those. Opinions voiced in the material are for general information only and are not intended to provide specific advice or recommendations for any individual.